Hi everyone and welcome to Inderes TV. Today we're going to talk about Harvia with Analyst Rauli Juva. Welcome.
Thank you.
So the Q4, how was it?
It was mixed a bit. Maybe it's good to understand first that the comparison figures were quite unusual. In the previous Q4 they had really strong growth from campaigns in the USA, over 30% organic growth, and then some M&A on top of that, and which kind of drove very strong growth in Q4 '24, but with a low margin. And now they were a bit kind of more or not so active with the campaigns, but they were still able to grow both in the US and for the group and improve the margin quite a bit from the previous year. So in that sense, I think it was quite solid development, but it was still the earnings was like 10% below the market expectations. So in that sense it was a disappointment compared to expectations. But the company was quite happy with the development, and like I said, it was still in constant currencies. It was around 10% growth for the group. So I think it was quite a good achievement anyway.
Solid, yeah. So Northern Europe grew more than our estimates. How much did it grow, and how much did the other segments grow?
Yeah, it was it around 15%? I'm not even sure about the exact number, but it has been growing like 10 to 15% now for both Q3 and Q4. So that was surprisingly strong from definitely from low levels that has been kind of struggling for years already.
So they're kind of back on track there.
Yeah, they seem to be back in business now also here in the Scandinavia and Finland and Baltics. So that's of course good for the company. And the other segments were growing as well. So the APAC and Middle East segment was not really growing, but there also the comparison figure was really strong. They grew 90% in the previous Q4. So it was kind of not that surprising that they weren't able to grow that much on top of that.
Yeah.
And like we talked about already, the US had also quite strong comparison figures, so not so much growth there. And then the continental Europe grew like 5%, like quite solid, stable growth, which they have been doing already for a few years. So it's a bit of a kind of a bit more moderate growth this quarter, mostly due to the high comparison figures. But the positive thing is that now it seems that all the segments are basically on a quite solid growth track. So in that sense, the outlook for this year looks really promising.
So they're all segments are back on track, kind of.
Yeah, it seems so.
So what about profitability and margins? The gross margin increased to 63%, but then again, other operating costs were higher than expected.
Yeah. That was maybe rather like my mistake on the estimates in the operating expenses, and then I was maybe a bit too optimistic. But the company has been in the big picture kind of continuing to increase the cost to drive the future growth, and to really build the company for being a clearly larger entity and investing into new products and product groups. So that's kind of a very consistent track. And I was perhaps hoping that when they had a bit weaker Q2 and we knew that they will have lower growth in the fourth quarter, that they would a bit scale back on kind of those costs, but that didn't really happen. So that was perhaps more of a choice and an optimism on my estimates rather than a clear weakness. And then the gross or the material margin actually in Harvia's case, that as you mentioned, that recovered really well from the previous years and was in a kind of normal range, I would say, for the company. So all good there.
All good there, yeah. You wrote that we expect the company to invest in long-term growth in the coming years. And you mentioned that already, kind of. But what does this mean in practice?
Yeah, exactly. So that basically means kind of building up IT systems, kind of hiring R&D people and developing new products. Like they bought this. If we think of Harvia in a big picture, they have been very strongly for decades in the traditional heater business, and of course they build full complete sauna rooms as well, but in the heater side it has been the traditional heaters, and now they bought 1.5 years ago this steam heater company Thermosol in US, and kind of now they are working to expand that product segment throughout the company from the base of Thermosol. And then they are also most likely, they haven't talked too much, but most likely they are also developing infrared heaters inside the company. So they would be actually kind of be able to play in all of the three main heater segments rather than only the one which they have been traditionally strong with, and that of course opens a lot of growth opportunities. So I would assume that the investments into that product development are a big part of kind of the increasing growth, but of costs, but also like the general things like I mentioned, like IT and other back office functions, and just hiring salespeople to kind of drive the sales that is clearly available in the markets, especially outside Europe.
So a lot of investments in
and that's that's investments in like a bit like in air quotes. So it's not the capex investment, but it's rather just increasing the running costs more. So it's not like they are coming down, but at some point the cost will increase less than the sales, and then the margin should improve a bit.
Yeah. So Harvia have several competitive advantages to support the profitable growth and value creation of the company. Could you mention the most important ones?
Sure. Yeah, they do definitely have one. Maybe the most important is the scale of the company and the efficiency, especially when we talk about this traditional heater and sauna business. They are still, even if they are not that large company, they are leading company that in a global level, and they have been doing it for quite a few decades, and kind of they have the production efficiency in place that they are actually able to sell at pretty attractive prices or competitive prices for the market, and do a higher margin than the competition. So that's of course a very good thing to start. And obviously they have then R&D expertise and a strong brand as well, to mention some of the other things.
Yeah, a lot of advantages there. Yeah. So the dividend increase for 2025 was quite modest, and management seemed to be prioritizing M&As. Based on Harvia's history, what kind of targets should investors expect, and what are the primary risks in this strategy?
Yeah, well, the main target is now they basically hit quite a bullseye with the Thermosol deal, buying a steam company from the US, which was kind of the number one thing which was expected before they did it.
Yeah.
And now maybe the next one would be, as I already mentioned, they are now in the kind of two main categories of three, so they would basically need something on the infrared side to be a kind of have the full product portfolio. So infrared company from the US would be the kind of ideal thing, that but some kind of infrared product expertise anyway would be probably the most likely and most wanted for the company as well. But they can do some other add-on acquisitions as well, but that would be maybe strategically the one that they are probably looking for.
Yeah.
And the risk, sorry, they luckily for them and the investors investing in them, they have quite kind of balanced approach in M&A in that sense, that the acquisitions they do are not like transformational for the whole company, but they are rather, if not a bolt-on, they are like adding on something in a like a moderate scale. So the increase in sales or the amounts they use in them, they are not like oversized compared to the company, so they are not risking so much even if like one of them wouldn't be such a success. Like most of them have been like successes in the past, so they have done a good job there. But if they, of course, there's also always a risk that you pay too much from something that you buy an infrared company hoping to scale it throughout the whole company, and you are not able to do it. But even in that case, if you buy a relatively small company compared to what Harvia is valued at the moment, and the kind of loss as such is not huge one. So the risks, I think, if they follow this strategy, the risks are relatively well in control.
Yeah, okay, but that sounds good. So what about valuation and recommendation?
Yeah, we jumped now to the buy rating after the share went down after the Q4 results. First time for a long while, so we have kind of had to admit that the company has been performing better and will continue to kind of show the kind of growth at the valuation levels that they are actually acceptable for the company, which we didn't quite swallow a few years ago still when we were negative on the company. But now that the PE is a bit around 24 for this year, and we are now, like I said, in a buy rating. I think that's pretty neutral multiple for the company. So we are not counting really the multiples to drive the share price in either direction. But they with our estimates, they are able to deliver around 15% earnings growth over the coming years, and then a few percent of dividends on top of that gives already quite a nice return expectation for the company.
Yeah. Thank you so much for all these answers. And if you want to know more about Harvia, go to inderes.se. And if you want to have more questions to Rauli about the company, you can log into our forum. Welcome.